Thank you, Ali. And so I'm gonna wait until about 2:05, Todd and Corky, before we begin.
We have 18 people now.
20. Okay, we're gonna wait for a little.
21, 22,
Start in about 10 seconds, they say.
24, 25, 26.
Stop reading that.
Right there.
Hello, everybody who are trickling into our panel today on film tax incentives. Everyone who's coming in now, we're going to give it just a few minutes to allow more participants before we formally begin. So we're going to start around 2:03 to 2:05. Give us some time to settle. Okay, so we're going to start the conversation. All right. So I actually think we are going to just begin, and people can trickle in after our start. So welcome, everybody. I cannot see any of the participants. You guys can see us. Welcome to Film Capital's panel on film tax incentives, a very exciting topic to me, and I feel it should be to everyone in the film industry and the finance industries. So today we have some really knowledgeable guests that I'm excited to introduce to you. I also want to mention the great guests we had earlier on the panels that Film Capital has put on. We had Hatem Diab, the manager of Gerber Kawasaki, Pascal Borno, founder of Angel Oak Films, Larry Namer, founder of E! Network, and my name is Maria Allred. I am a filmmaker. I am a writer, director, and producer. I own my own company, film production company, Allred Films. And I am currently working with Corky and Todd on a film that I am an executive producer on, Alaska. And I know how much expertise they bring. So I'm very excited for all of our audience members to glean from their knowledge. They are the best in the industry as far as this topic goes. And so I'm going to introduce them now. And I will say about Corky, he has a very extensive bio. We have a shortened version here, so we don't take the whole hour reading his bio. If he wants to fill in any gaps, he can do so. We have Corky Kessler. He is a partner with Rubenstein Business Law. Corky has successfully worked with governors and US congressmen in several states to implement new laws and federal tax incentives for investment in qualifying film and television projects, which led to Section 181 and Section 199 of the American Jobs Creation Act of 2004. Corky is active in establishing and advising various film funds and film funding sources in North America and is expanding internationally. In October 2012, Corky signed a memorandum of understanding with private investors from China for a $200 million co-production deal with the US. And we have Todd Hein, who is a certified public accountant with over 30 years of experience in taxation of entertainment ventures. He has worked for a top 10 public accounting firm and is now an independent accountant living in Colorado. Todd actively participates as a board member in arts-oriented nonprofit organization and speaks frequently at film festivals. He has active clients throughout the United States. So without further ado, I'm going to turn the floor over. We're going to start with Corky. If you can introduce the topic of the day, and go ahead.
Okay, thank you, Maria. Okay, hi. All right, so
pause one second, and I'm going to repeat this again, but for the participants, I want to let you know there is a Q&A tab in the bottom, and if you have any questions, just type it into the Q&A tab. I'm going to be checking that regularly throughout the panel, and I will be answering some of those questions as we go, as it fits, but we'll also have a dedicated time for Q&A at the end, about 15 minutes or so. So type in all your questions and we'll try to get those answered. Okay, excuse me. Go ahead, Corky.
No, that's okay. You can talk anytime you want. So I was involved with 181, Section 181 of the American Jobs Creation Act of 2004 since the inception. And I was very active in the application since it began. And it's been around since 2004. And in the American Jobs Creation Act of 2004, the document was 1,500 pages, and the explanation of Section 181 was less than 1 page. And I'm the one that had to straighten out the trades when they got it wrong, and I helped the IRS through some of the permanent rules for it. So let me introduce what 181 is, because it ends at the end of this year, and then we can talk about what started, which was 168G and K, which is the new incentive that has taken over and will be around till the end of 2027. Okay, so 181 is principally a jobs bill, and 181 has to do with the following. You can expense up to the first 15 or 20 million dollars to be an expense, and taxpayers, when you spend their money, it's spending triggers it, not investing. Spending triggers it. When you spend their money, it's 100% loss. How to characterize the loss, you will check with Todd and I as to how to do that. But it's 100% loss upon spending. And 75% of the service wages have to be performed and paid for in the United States. 25% can be spent in any foreign country that you want. So you can package the incentives with foreign countries, which is good. And it cannot be a sexually explicit movie, and you have to make the election on the first tax return, or you cannot be a 181 film, and Todd will explain that, because Todd is the one that I usually go to make sure my clients have the proper situation to make an election on the first tax return. The other thing about 181 is you cannot capitalize your production expenses. So when you spend it, it's 100% loss. Spending triggers it. And once you're grandfathered, you're 181 for life. And since 181, and there's no end date, and since 181 ends at the end of this year, I will briefly say what you need to grandfather, okay? You need, by the end of this year, A, to have a screenplay or teleplay. You need to have a summary budget. You need to have 1 day of photography with some dialogue, but you do not have to use it in the final product. And you need the investor documents that I generally prepare, but you don't need investors. And all these things can change in some part, but you need everything that I told you in my file by the end of this year. And once you do that, and once Todd does what he has to do to make sure the election is on the first tax return, then you're 181 for life. And just a final comment, with our law firm, our Rubenstein Business Law, there is nothing that we can't do for clients. And we are a full-based firm that can make sure that whatever you need, once we are brought on board, you can do. We can do anything that you want, funding and distribution and talent. And for those of you that want to come to our panels on Wednesday, the 24th, we're doing virtual panels during Cannes. And if you email me, I will send you the Eventbrite. We have Tony Shalhoub, Jason Alexander. We have Academy Award nominated people on the 24th. And then we have a pitch contest on the 25th. And the winner of the pitch gets $20,000 of free service. So if you want to get the Eventbrite, you can email me, and I'm going to go very slow. C. Kessler, Kessler, at Rubenstein, RUBENSTEIN, businesslaw.com. And now I turn it over to Todd.
Okay, thanks, Corky. Corky and I have worked together for, I don't know, 7 or 8 years, right, Corky, in that range? And what I do is I take the theoretical law and the documents that Corky is smart enough to draft and translate them to 2 people. One is the IRS, and one is to the potential investors for your projects. So my only real talent is, I think, being able to explain things to people in a simple but not simplistic way so they understand what they're doing. And Corky is correct about the 181 election being important to do properly on the first applicable tax return. That law is a temporary, not a permanent law that is supposed to sunset again at the end of 2020. And we don't know if it's going to be extended. We never do. It probably will not be this time. That's my impression.
The same as
So,
my,
yeah. So the time to use that tool is now. And the way that I look at the tax law is that they're tools in the toolbox, basically, and that you can select the timing for taking deductions for your project expenses. And depending on the investor, they may want to take the deductions now. They may want to take them later. They may want to tie the deductions with revenue streams. And there are ways that I could help design those deduction flows so it matches up with your investor profiles, with the idea that being a CPA, I know that CPAs are known as deal killers for a lot of investments. So what I do is I talk to the investors and their accountants and their lawyers and explain to them how this process works so that misunderstanding of the tax law that's applicable to film production will not impede their investment. And once that is done, and I talk to the investors and make sure that they understand the process and that their CPAs understand what they have to do on their end, then I make sure that what I have to prepare, which is the K1s, which is part of a partnership tax return, are delivered timely and accurately to the investor's accountant so they can't complain. Because the last thing that you want is to have everything go well with the production and begin to make money, but have the accountants for the investors be in a bad mood.
okay, well, also for a television series, since you have to have one day with some dialogue, and each episode of television is its own production. So what I tell my clients is, do you one day that you can repeat in every episode, so you can be 181 for all of the episodes. So if you do the beginning or the end with some dialogue that you can repeat from episode 1 to 2 to 3 to 4 to 5 to 6, then you can be 181 for all of those because you've completed one day.
That's smart. So I want to tell everybody who has joined us a little bit late that if you have any questions, there's a tab at the bottom, a Q&A tab. You can write your questions in there and we will ask those as we go along or at the end in our Q&A section. I do have a question in there now. I'm going to get to that in a moment, but I want to just say, as a filmmaker who is utilizing these incentives for a current project, Alaska, it's pretty simple. And I just want to emphasize, and I want Corky to ask you to emphasize what a big deal this is for investors, what it means as a filmmaker to be able to offer this to an investor. It's the total loss, as you say. Can you go into that a little bit more, what that means? Yeah.
Okay. All right. So let's say you're a 35% taxpayer that invests. Once the filmmaker spends that money, they have a 35% benefit. They have 100% loss against, if they're active, their taxable income, or if they have if they have some profit from an investment that they need to protect. They can take a loss from that. But let's start. You got a 35% taxpayer. Once we give them the 100% loss on spending, they get a 35% benefit. If you spend your money in a state, let's pick a state that has a 30% incentive, that's spending also in that state. Now you have a recovery to your investor of 65 cents on the dollar, the 35% and the 30%. Those both come from spending. And since you're allowed to do 25% outside of the United States, if you do your post in Canada, Like I have a lot of people go to Canada, their post through a company called Eggplant Pictures. But if you were to do your post in Canada, you get another 6%. So now you're at 71 cents recovery on your investment, regardless if the film does any business. There's no other business in the United States that you can open your door and get a 71% recovery, except for film and television and now actually theater.
Yeah, and I want to just say that, film has always been considered a risky investment, but this is a great risk mitigation.
Well,
So now it's been considered, what you
okay.
say, a conservative investment, right?
Okay, but there's something else. The New York Times, and if they email me, I'll send them the article. The New York Times had an article, and principally it said because of the federal and state incentives, now investing in film, independent projects is, and the New York Times said, it's not me, a conservative investment. So when the New York Times calls an investment in film a conservative investment, that's an unbelievable statement that the New York Times made.
Truly true. So I have a few questions down here that I'm going to look at. The first one is, so this is by Kahindi. I'm not going to read the names, actually. I'm just going to read the question. What are the risks that COVID has created in terms of sudden changes in tax credit legislation?
There's none. No change.
No change with the COVID.
No. The states still have their incentives.
Yeah.
The federal government still has their incentive, and I'll go into 168 at some point later. That's the incentive that's going to continue. No, there's no difference.
I would say that there's a good probability that other states will start to have their own tax incentives as business opens up in the film industry, because California is still relatively tight. Other states may have a more progressive point of view as far as opening, and they may start to do their own tax incentives. So I don't see it as an issue at all.
Yeah, that's what I was thinking as well. Okay, so the next question here, can you please repeat what won't be renewed next year, Corky?
Section 181.
But can you also tell how you can grandfather? So this question is, 181 is being sunsetted, but for everyone who's listening, it can be grandfathered. So if you grandfather it through with Corky Services or whomever else you may use, you are eligible to use 181 past this year. So say you're going to shoot next year. There's
no date. There's no date.
There's no expiration. So again, can you explain, Corky, how to grandfather a film this year so that you can utilize it even if you shoot next year or the year after or whenever?
You need a screenplay or teleplay. You need a summary budget. You need 1 day of photography with some dialogue. And you need the investor documents, but you don't need investors.
Okay, so everybody out there, 181 is being sunsetted this year. It may be renewed, but both Corky and Todd believe that it is looking unlikely that it will be renewed, but your projects can be grandfathered through this. As Corky just mentioned, the things that you need in order to grandfather. And what that means is you're eligible to use it even if you shoot 2 years from now, 3 years from now, as long as you're in that stage of development.
5 years, 6 years, yeah. But I'll be grandfathering, I project 40 to 50 projects by the end of this year. So if I'm going to grandfather them, we should start soon so I don't get a backlog. There was 1 year when 181 was going to expire before it got extended. And someone called me up and asked me to grandfather 38 projects. December 1st, I got the call. I said, wait a minute. It's December 1st. It's going to end in 30 days. And you want me to grandfather 36 projects? Well, we did it. I mean, it took me hours and hours and hours, and he paid a lot of money, but 36 projects. And Todd knows them.
Okay, so another question we have here is addressed to Corky. What is Bill 172? Someone mentioned this to me regarding a similar structure. It wasn't Bill 181. Did I hear incorrectly? Bill 172.
Okay, 172. Todd, do you want to tell them what 170?
I mean, we get lost in the soup of IRS code sections, but 172 obviously is a totally separate section from 181. And 172 is an established code section that pertains to net operating losses and how to either carry them back to offset prior year's income and get tax refunds, or carry them forward and reduce the tax burden in the future.
So 181 can be carried forward, he lost 21 years, or carried back 2 years, and you can get refunds from the IRS. You can carry it forward 21 years, or you can go back up to 2 years.
Yeah.
181.
And with the CARES Act, you could actually carry back for 5 years, which is a temporary new tax incentive. You have to create the tax loss in 2018 or 19, and then you could carry it back for 5 years. So for certain people that have large incomes going back to 2014, some people are excited about carrying those losses back. But just to be clear, 172 is the legal mechanism that allows you to carry back or carry forward the loss. The loss is created via 181. So there are different code sections, they have different purposes. And just like Corky said at the outset, I would recommend that you don't get too involved with your investors or their accountants or their lawyers about talking about these specific tax provisions, because as soon as you start to talk about it, if you don't know what you're talking about, the CPAs will know. And that's something that you don't want to give them the ammunition to say that you don't know what you're talking about, and therefore we're going to do the deal. So the best thing to do is to defer to Corky or me, and we'll actually send them the code and the regs and all the goodies so that it could be documented properly, not have you guys misstep.
There are a lot of people that don't believe. Their accountants will call me and say, I don't believe what you're saying. And I then said, well, I'll give you an accountant that will talk to you about what I'm saying. And then after Todd talks to their accountant who didn't believe what I'm saying, the accountant will tell his client what Corky said is true.
Right.
Yeah, no, it sometimes does seem a little bit unbelievable. Like, this is too good to be true. I had to really get into it. So I have another question here. If the investors take 100% loss, then surely all income, e.g. state or foreign incentives, will be taxable and reduce their 35% loss pro rate.
Well, that's very interesting. There is 199. 199 now, it's 199A, gives them a 20% discount on all taxable income that comes back for their, project. So once they've taken the entire loss, they have a zero basis. So let's say $1 comes in, that's taxable because they have no loss. They only pay tax on 80 cents. They have a 20% discount under 199 capital A.
And that's with the profit.
Yes.
That the film makes.
Taxable income.
Taxable income. So with that question by Ivan, if that was not answered, you can let us know with a follow-up question. Yeah, so I mean, because I wasn't totally clear. It says all income will be taxable and reduce their 35%. And you're saying no, with 199, that isn't the case, Corky.
Right.
Then that's additional.
Look, in 2007, somebody calls me up in February of 2007, 181 was there, and said to me, your client, Corky, told me about 2 projects that he's doing. And he says, Corky, I sold my business in January, and he calls me in February. And I found out that I'm going to have to pay taxes at the end of 2007 of $5.1 million of taxes. Your client, Corky, said, if I give him $6 million, he'll spend 3 million on each of his two movies by the end of 2007, and then he'll have a $6 million loss. And he says, is that true? Yes, he did it. So it reduced his taxes to under $1 million, and he made $36 million on the two movies. Less at that point, it was 9%. So this guy was so happy that we relieved his tax burden that he didn't care about paying taxes.
Yeah. Okay, because he also made that great of a profit, which is, so you're investing, getting 100%, 100% loss in your investment, plus you're able to make a profit. So some films may not make a small profit. Some films may make a huge profit, like you just mentioned. So that's, that's always a risk. Okay, so I thought 181 had sunsetted a few years ago. When did it come back?
All right, 181 has been extended every year since 2004. 2004 started out with 3 years, and then each time it's been extended. So the last extension was towards the end of 2018, Todd?
Yep.
Okay, and it extended it to the end of 2019. Okay, and then we picked it up. So at the end of the day, they extended it to the end of 2020, realizing it's going to be the last hurrah under 181, and they're going to pick up with 168. 168 came about in September of 2018, and 168 difference in 181 says that there is, the film has, and the TV project and theater has to be put in service. It means you have to show it. That is the difference. 181 is spending, which is much better, but going forward, you're going to have your project shown. And at the end of the year, it's shown, you get the loss.
Okay, yeah, that's great. You answered that or said that, because there was a question that I missed that asked you to discuss 168. So Ryan, hopefully that answers your question. The difference is that the loss comes once the film is shown or the TV show is shown with 168, whereas once the money is spent with 181, that's when the investors can receive the loss. So the next question here is, will Code 172 expire after COVID-19 ends? When will it end?
Well, 172 is a permanent code section, unlike 181, which is not permanent. It has to be renewed every few years. But 172 has been around for many years and allows you to carry back or carry forward losses. The CARES Act portion of it that pertains to 5-year carryback, I believe, ends at the end of this year. But the actual carryback for the 2 years, which is the normal net operating loss carryback, and the 420 is a permanent tax law that could be altered in the future too. I mean,
look, I've had people get refunds from the IRS because they carried it back.
Yeah, refunds. So hopefully they answered your question, Patricia. So basically 172 is a permanent tax law, but the CARES Act that's a new thing with COVID-19. Todd?
181 uses 172 for carry back and carry forward.
Carry back and carry forward. Okay.
Permanently, 181 is not. It's going to sunset at the end of this year.
Yeah, but Patricia, the 5-year carryback, which is an extension of the usual 2-year, is a thing that's temporary, having to do with COVID.
That's exactly right.
Okay, so that answers. Okay, great. So next question here is, what is the % of funds that need to be spent in the US on the production?
75% of the service wages in your budget have to be performed in the United States. Service wages. 25% can be spent in any foreign country.
So then, so the above the line, that doesn't apply to the above the line?
It's the service wages in the budget. For example, it's not the completion bond.
Yeah.
It's not the insurance. All right, it's the service wages that are performed in the budget. 75% have to be in the United States and 25% can be anywhere in the country. So you can piggyback another country's incentives with
Yeah.
your.
That's great. That's so great. That's so exciting. Okay. Are investors permitted to take loans, either full or limited recourse, to make 181 investments?
Wow, that's a good question.
That's a
Yes,
good question. I was like, woo.
that's a very good question.
Yeah.
If you take out a loan and it's a recourse, you're at risk for the loan, then that's 181. If you take a loan and someone guarantees the loan and not you, and you're not at risk, the guarantor can take 181. So it's the recourse on the loan that makes it at 181.
That they can use at 181. Okay. So you can invest with your loan, but you can't use 181 unless you're at risk. So the person who is the guarantor would be the one who could take out 181.
Right.
One caveat on that is that I often get asked, can an investor do 100% debt as the investment in the film and still get the 181? And the answer is no. It's the owners of the project, meaning the LLC members, that will receive the K1 that has the losses on it. If you're purely a lender, then you're just like a bank, and you will get hopefully interest on your money and the principal repaid. But in general, I have a lot of clients that are doing 20% in equity and 80% in debt. That seems to be a pretty common ratio. And for that, since they're going to get a K1, then they will in fact be entitled to a deduction for their full investment consisting of the debt and the equity. It cannot be 100% debt and
Right.
get an allocation of the losses.
Okay. Let me see here. Are there minimums for, I'm kind of turning this whole thing into a Q&A, but this is good because this is what this should be. So are there minimums for the investment amount for theater, film, series?
No. When I do the LLCs for the investment, you have to decide what each unit investment is going to cost. So I talk to my client, it depends on how large the budget is as to how large I recommend the individual unit for the investment would be, but there's no magic number.
Yeah, the only thing that I'll say is that it can't be zero, because to make a 181 election, one of the triggers that I have to describe in my election statement in the tax return is that there has to be cost incurred, which means that if we do the LLC on the accrual versus the cash basis, you don't have to write checks to anybody, but you have to have somebody, a DP or an EP or somebody, invoice you for something because the election is made in the year in which you first incur costs. So I have a lot of clients that call in favors from people and maybe get free camera and free this and free that. So they don't really have any cash costs to report on the initial return. But we have to come up with something to say that they incurred some cost. I wouldn't do $1. Most are 5,000. That I would say is just like a ballpark number.
When I prepare the documents, there's a cost. Okay? So that can be a cost that you can go to Todd to do the election. But at the end of the day, I mean, Todd is right. That you only get 100% loss under 181 when the money is spent. It's not when it's invested. Spending triggers it.
Okay, yes. So will the 171 and the CARES, will the 171 and the CARES Act allow 168 to be retroactive 5 years from the release of the film?
Yeah.
Yes, I mean, the way that you create the loss doesn't really matter as far as carrying it back or carrying it forward. You have to create the loss first, and then you can carry it back. So, and it's section 172, not 171. But
yeah, that's it's 172. Yeah.
Right. So I have one investor that did $3 million in a film, some equity and some debt, and was able to carry back for 5 years from his 2019 tax return and got it back $600,000 in taxes that were paid in prior years. But again, I hope the people that are asking these questions, which are good questions, but they should not be going, in my opinion, this far with the investors on their own in general. If it's for their own investment, then I totally understand, but they should not be talking about the code in this level of detail, in my opinion. I don't know. I would think that
Some people joining us may be investors, maybe financiers
Yeah.
as well, though.
yeah, if it's investors, that's fine.
But it's very important. At the end of 2020, the 100% loss in 2023 becomes 80%. Then 2024, it's 60%. Then 2005, 40%. 2006, 20%. So it goes down less each year till 27. So keep in mind, your best 100% loss is if your film or TV or play is shown in any year before the end of 2022. Because after that, the loss becomes less and less and less until 2027.
And so all the participants know that's referring to 168 because that's the one where it needs to be shown.
Right.
So can an investor buy the corporation that made the film, say in 2020, even though the film is completed and third parties actually paid the wages, but the new investor owns the copyright in the film and still gets the benefit of the tax loss carry back and carry forward?
The owner of the copy, it doesn't matter who owns the copyright of the film.
Asking the corporation, can the investor buy the corporation that made the film? But the new investor owns the copyright in the film. So good. Okay, so good. Did you understand the question? Do you want me to repeat it for you?
Wait. I can't.
What?
Okay. Repeat the question.
Yeah, I'm going to repeat the question for everyone. Can an investor buy the corporation that made the film, say in 2020, even though the film is completed and third parties actually paid the wages, but the new investor owns the copyright in the film because they bought the corporation and still get the benefit of the tax loss carry back and carry forward? Okay, that makes sense.
Okay. Someone can buy the copyright and the rights to the film. And once they buy that and own the film, what the investor gets, who that is paid, that's what they have to report on their income taxes, because that's revenue they get. But once it's bought, the new company that owns it can add any money they want to the film and they'll get a new 181.
Yeah, keep in mind that 181 does not apply to completed films. So if you're talking about the trade and sale, the purchase and sale of completed films that have already been shown or are ready to be shown that don't need any post-production, that are really in the can, I guess is the term. I'm not a film person, but
No, it has to have money needed, right? For
right.
new.
So a completed film that you buy, like the studios do or Netflix buys or whatever for VOD or for other distribution channels, that would not be 181. That's a whole different code section that allows them to amortize the cost of the films over a certain period of time. So that question is very fact specific. So that's something that you have to ask Corky or me or both, probably, if your investors are thinking about purchasing completed films versus films in process. They're two different things.
Okay, so it has to be a film in process. It cannot be in the can, cannot be completed. Alrighty, so can you please elaborate on what's required for television? Would a 1 day with some dialogue mean I'd have to shoot 12 1 days if I planned on the project being 12 episodes for one season? What if I wanted to 181 more than one season? So Corky did answer this earlier, but why don't you repeat what you said earlier, Corky?
Okay. If you repeat the 1 day in every episode of your movie, you can carry the 181 for everyone that has that one day. You can carry it forward, but you have to repeat that one day in each episode. So if you repeat the episode in the second series, if you repeat that one day, you're still 181.
You could put that one day into a title sequence, for example, as long as you use a little dialogue, or into an end sequence. You can shoot for one day as long as you just use a little bit of dialogue, and you can put that into some. Go ahead.
And when I asked the IRS what one day meant,
Yeah.
the gentleman at the IRS said to me, Corky, when do you start work? I gave him a time. He said, when do you end work? I gave him a time. He said, that's one day. Okay, so there's no magic number. And usually 1 minute of your film is one day.
So for the person who asked that question, it might be difficult to use one day of shooting in 12 episodes, obviously. But if you wanted to get kind of creative and try to do that, that would be a way to carry it forward easily. Otherwise, you would have to shoot separate days to, be applicable.
But if you don't do that and 181 ends, you're not going to be 181 for the new episodes.
Yeah.
Each episode is its own production under the tax code.
Yeah.
So 180,
So if you wanted to do separate days, the person who asked that question, if you didn't want to use that same 1 minute little clip for each episode, because you couldn't do that, you would have to try to shoot all those before 181, and so you can grandfather the entire season through, and then also for subsequent seasons as well. So, and it's ending this year, and they don't know if it will be renewed. So,
so keep in mind that it's 44 episodes, right, Corky? Which I guess used to be the standard. Now I'm seeing mostly in the 20s and even less for some of the other shows that I've seen. They're more like 6. But I think that the logic with this is that if I need to sit down with an IRS auditor and present to them the 181 deduction for 44 episodes, there better be something decent that you've used in all episodes, including the dialogue and the film. It has to make sense to the IRS auditor who's not in the film business. So I think it has to be a common sense thing. So as far as the day goes, whether or not you can use one day of principal photography for 44 episodes, it's probably possible, but it's got to make sense to the IRS. So people in the tax world like to extend the tax law way out to the margins and take total advantage of the code. And I think you could do it. That would require some fine tuning from someone like Corky to be able to do that properly. If you're going to do it for yourself and it's only for you as the EP and it's your money and or whatever, I'm not too concerned. But as Corky knows better than I do, if you get other investors involved and the SEC is involved with the placement of the investment, you don't want to do anything too much on the edge without precise legal and accounting advice. Anyway,
Right.
that's my
absolutely. Okay. Do these codes and laws apply to animation?
Yes,
yes.
but in animation, it's the number of cells that will trigger it, not one day. It's the number of cells in animation that you have to do.
How many cells are
Well,
required?
I don't know.
I think 10.
10 cells of animation. Okay, to be applicable.
Once again, with IRS logic, you can't do one screen and show it to them and,
No, it has to be different cells.
yeah, this has to make sense.
Yeah. All right. And there's a question here. Apologies for the newbie question. No, newbie questions are great. When Corky is talking about 181 kicking in when funds are being spent, as opposed to it kicking in when funds are invested, what is the distinction? Just want to double check.
Okay, let's say you have an investor that gives you $50,000. That investor doesn't get the loss until that $50,000 is spent. Not when they invest and you have the $50,000. You have to spend it. Spending triggers it. So you could spend part in 2020, part in 2021, 22, 23, but they get it in the year or years that the money was spent.
Okay,
So the
well,
way, I was gonna say,
oh, go ahead. I was gonna
And
put a
so-
question on that question, actually, Todd. And so that means that if they spent 20,000, say in 2020, they would get that loss, Todd, of that 20,000 in that year. And then if they spent 30,000 in the next year, they'd get that loss of that 30,000 in the next year. Is that
Right.
true, Todd?
I think that the way to explain it is that as a producer of a film, you're making a machine that's going to make money. And in other areas of business, you can't deduct the cost of the machine until the machine is working and producing product. So with 181, as you spend money on the machine, as you weld it together and put the wheels on and paint it, all those processes, even before it's actually working, that's when you get to deduct the cost of making the machine under 181, as opposed to other code sections that will make you wait till the machine is producing revenue like 168K, meaning that the film is shown. So it's really just an earlier deduction of the same cost. So the way the studios make movies is that they use a whole different code section that includes the income forecast method, and they have to put all their costs for making the film in a big pile and wait till they sell it or license it, and then they can amortize the costs that were piled up against revenue as it comes in. So it matches the revenue and the production cost together. That's how studios do it. 181 lets you take the cost of production as a deduction as you spend the money, like Corky said, which is earlier, which for a lot of investors can mean the difference between paying tax and not paying tax if in a certain year they had a transaction that requires an offsetting deduction to large income. So it's a way to time the deductions.
Right.
I want to add something to the that person who asked that newbie. So once a person invests their money, they don't just get to take the loss that year unless the money is spent. So just investing it does not initiate the loss. So if the film isn't being made and the money isn't being spent in that year, they cannot deduct it. But if the money is being used, if the film is being made and the money is being spent, then they can deduct it in that year. The money has to be spent on making the movie to that newbie. So.
Right. And distribution expenses are not covered.
Okay, that's I'm going a little too far. Okay, so we're going back to 199A. Is it true that the 199A is limited to the first 415,000 of income and is then phased out for income greater than that? From what I understand, other tougher and smaller limits apply to partners based on their sources of income and entity structure, but it wouldn't be right to imply unlimited exclusion.
Okay, Todd?
Again, this is a very specific question, and 199A, the deduction is allowed to reduce by 20% under certain circumstances, certain kinds of income, but not others. So the phase out that they're talking about at $415,000 applies to certain kinds of income, like lawyers and CPAs like Corky and me, So for other types of investors that own a business, they can deduct even if their income is in excess of 415. But again, it's a very fact sensitive question. And so to say that none can take a higher amount is incorrect. Some cannot. So I think that's what the answer is for 199A.
The true answer is that's not a limitation. It's not a limitation. And so that does not apply to this.
Okay. As a follow-up to the question about buying the company that owns the film, and therefore not only owns the film, but the company that made the investment, and the film is not 100% complete, but let's say it's 90% of the film is complete. Since no one else can get the loss, carry back, and carry forward but the owner of the film, can that new owner still get the loss carried back and carried forward?
Only what extra they spend beyond the purchase money.
So the purchase money doesn't count as like,
Oh, no.
it's just the money that was spent. What if they reimburse the money spent on the film though? And so it's almost as if they
No,
spent that money.
it's taxable to the filmmaker. It's only the extra money that the person spends.
On that actual film itself.
Right.
So to that question, that's an interesting question to me, but it sounds as if you purchasing it, even if the film is not complete, it's in the making of the film, you have to put more money into the actual film itself as it's still in process of being made in order to apply, be applicable for 181.
Right.
Okay. All right. Let's see if there's anything else down here. There are. Following up on the necessary dialogue to continue the 181, can you make a film where the dialogue appears and then continue using that bit through a TV series that follows based on the movie? So a TV series that comes after a movie.
Well, okay. It's a very interesting question. One, I would worry about 181 for the movie. And if they're fortunate that there's a television series that comes from the film and that one day is for the episodes of the television series, we have to be very careful on how we draft it because it's going to have to pass Todd's mustard, but it's going to be a very complicated issue.
Yeah.
So let me bring up one main point, and that is that you make the election under 181 per production, and it's made by the entity that owns the production in the year in which you first can qualify. But you have to name the production in the election. So it's not like you're qualifying an entity, you're qualifying a production. And you are saying under penalty of perjury when you sign the return that you feel that this is going to be a qualified film, TV, or live theatrical production. And you can't really transfer from film to TV or TV to theatrical or theatrical to anything else. Kids are here. But so it's a production that you transfer. Most of the time when you complete a film, and Corky knows more about this than I do, once you make the movie and you pay off the investors in the LLC according to whatever terms they've agreed to, then depending on what happens to the actual product, you could either keep it in a library company, you could sell it to a third party like a studio to keep in their library. But the LLC is usually a finite entity that makes the movie, repays the investors, and then you transfer the production onward to another entity. So that's more in Corky's realm than mine. But I just wanted to comment that you do qualify the production under 181, and you can't, in my opinion, mess around too much with what that production is. Like you can't go from a comedy to science fiction. It has to be, it could be a comedy where you change the venue or change the script or something like that. But there has to be something for the IRS to go back to Corky in his vault and pull the DVD out or the thumb drive and compare that first day of shooting to what actually is appearing on the screen. And there has to be some easy to follow relationship between the two.
Yeah. I mean, I have to make sure that one day with some dialogue is identifiable in the screenplay that I have in my file.
Right.
All right. I have a question here on 168. So 168 benefit is on release, not spend, and there is a diminishing rate of loss. Are there any other significant differences to 181?
Yes, there's no maximum amount. It could be $100 million movie. It could be a $50 million movie. There's no maximum. That's the major difference.
And the only thing with 168K, like Corky says, there's no practical limit to the deduction that's available to investors once the movie or whatever is shown. But 168K in the section that applies to film and TV does refer back to section 181 as far as how it qualifies.
Right.
The maximum amount of deduction isn't there, but you still have to follow the rules in 181, even if 181 sunsets.
Right.
181 is going to be a legacy code section that'll help people determine if their production qualifies in 168K.
Right. A 75% service
Right.
wages in the United States, 25%
Exactly.
wherever, and it cannot be a sexually explicit movie. That's
Right.
Okay. So that applies to 168 as well. This is incredibly helpful. Thank you, someone says. Wow, even more clear. Thank you. This newbie is very appreciative. All right. So we have reached the end of our Q&A tab at the moment, and we're at 2:55. This has been really full of information. Are there any more questions out there, or right now, is there anything that Corky or Todd, you would like to add to help make this clear, the benefit of this, how simple it is? Anything else that these filmmakers and financiers need to know?
the final thing that I want to say. If you put all of the movies that were nominated for Best Picture at the Academy Awards for the last 3 years in one bundle, only 4 or 5 of them were not wholly or substantially privately funded. It goes to the independent filmmaker. You control what is out there. And therefore, I wish all of you great success, but 181 is really the goose that laid the golden egg. There have been times that I spoke about 181 to about 100 filmmakers in the past, and then I've asked the audience, how many of you know anything about 181 or have used it? And maybe there's one hand that goes up, that's it. And I tell people, if you don't know about 181, whether you use it or not, if you don't know anything about it, you should fire your lawyer and your accountant. But I don't care who you hire, but you should fire them because it's their job to make sure that you're current.
Yeah. I do have a couple more questions. We have about 4 more minutes. It says, please, can you reassure Todd Corky that I at least have no intention to do this without professional advice, but want to understand it clearly so it's not waste our advisors' time. Absolutely. Okay, they're going to go with professional advice. Okay, so can you do both episode and movie for 181? Meaning
No.
for the same project, same project. So can you do both episodic and a movie for them?
Todd said, when you make the election, it's for a particular project.
Oh.
And so you can't then later on, when there's no 181, remove it to another, project.
What if the filmmaker is doing both a film and an episodic for the same thing? Can they, when they're doing it, can they apply both of those for 181 at the same time?
Yes, as long as it's in the investment documents that I prepare, as long as you raise money for both. Yes.
If I were an investor, what I would do is I would ask to see the documents that Corky made and the tax returns that I make, and make sure that the production flows through the documents, through the budget in the production, onto the screen and on the tax return. So it'd be pretty easy in this case to do proper due diligence if the investor's accountants knew what they were doing. So the whole idea is to be able to trace the thread of the film from inception to production to how it appears on the tax return. That's the key element.
Okay.
And so anyone who wants to go to the panels on Wednesday, they're all day, and there's a virtual pajama party that night too. And then the pitch contest the following day. If they email me, I'll send them the Eventbrite, because tomorrow's the last day. We're going to take down the site.
Okay, so I think that also Film Capital may be sending out something to their people about this, so it gets out to the people who are here. Yeah, and Todd, we have 1 minute if you'd like to say any closing comments before we sign off.
Yeah, I'll say that that my main job is to make sure that new producers get a second bite at the investor apple, meaning that most first time productions don't make money, but as long as the investors are happy and their accounts are happy, when you go back to them for your second movie or your second pilot or whatever, they'll be much more amenable to hearing from you if we do all the I dotting and T crossing. Also, I am, this is not all I do. This is something that I like to do because I like the film industry. And often I will give quote unquote free advice to new producers and directors and writers with the hope that at some point they'll do something with me that will make us both money. But I would encourage anybody that wants to talk to me about the nuts and bolts of the tax side, they can certainly send me an email and we could publish that, or my phone number. And I'll talk to you about it first, just like I did with you, Marie, at the outset, you know, and to get you off on the right track. Even if you don't end up using me, I like to keep these things moving and keep the image of the independent film industry positive to investors.
Absolutely. All right, everyone. So thank you, everyone, so much for joining us here. This is a pretty weighty topic. It's not the most simple. So I hope that this helped elucidate it and clarify things for you all. And if you have any questions, you can, I think that the emails are being sent out. You can reach out and move forward with these two fine gentlemen, the experts in the field here, and with Ali of Film Capital. So I think we are going to sign off, and thank you all.
Thank you, Maria, and thank you, everyone.
Thank you.
All right, goodbye.